I was asked to speak here on a few topics. One, just recent updates for healthcare. The regulators release new rules related to this about weekly. So it's a constant battle to stay up with that. So I'll cover that a little bit, and then we're going to talk about primarily the employer penalty aspect of healthcare and how you might go about managing to either avoid or minimize those penalties. I think I put penalty proof in the title. As an overview, there's kind of three overarching points to the Healthcare Reform Act. One, starting in 2014, every individual in the U.S., or at least almost every individual, will be required to have health insurance. So if you don't have health insurance through your employer, you'll have to buy it individually. There are a couple of exceptions to the penalty. One way of not being required to have health insurance is to be too poor to have health insurance so that you end up on Medicaid. Another way that you can avoid the requirement to maintain a health insurance policy is to be incarcerated. I know some people are really committed to being tax protesters, but that seems a little extreme. I think I'd pay the $95 tax as opposed to being incarcerated. But though I suppose you do have free health care when you're in jail. Related to the requirement for individuals to have health care coverage is, so if you have to buy it, where do you buy it? Under the Act, they created what is now being referred to as the Health Benefit Marketplace. Statutorily, it's called the Exchange, but the administration has changed the name because they think it markets better, it sounds better. That way, individuals can purchase insurance. This is private insurance. It's not government-provided insurance, but it's private insurance. And possibly, depending on your income, receive a tax subsidy for doing so. And we'll talk about that a little bit, but we're mostly going to focus on the employer side. The third component to healthcare reform is the requirement for employers who are large employers, and we'll talk about what a large employer is to provide health care coverage for their full-time employees and their dependents. More recent developments. In one of the requirements of the Act is that employers provide a notice to their employees of the existence of the health benefit exchange. Earlier this month, or actually it was actually in May, we're in June now, in May, the Department of Labor released a model notice that employers can distribute to their employees, telling them about the healthcare exchange or marketplace, there's a number of issues related to that. And then there's a requirement for employers that sponsor healthcare plans to provide a summary of benefits and coverages. And there's some changes there. And then just recently, California released what their exchange policy rates are going to be. That's been one of the real issues, is how much is it going to cost to buy a policy? Switching back to the notice here, the notice is due no later than October 1, 2013. So as an employer, you need to be sure that your HR department is on top of this, because this is a required notice, and there's timing on this for new employees. New employees must receive the notice within 14 days of their employment start date. So it's going to be one more thing that you need to have in your new hire package that is going to be something that HR groups will need to be on top of. There's also been a lot of talk in the news about different ways that employers can manage their requirements under the Act to provide health insurance. And one approach that some employers have been considering is to provide a very low value policy to their employees and make it a mandatory condition of employment that you accept that coverage. And by doing so, that precludes people from then going to the exchange and getting subsidized coverage, which is a way for employers to avoid the penalty being triggered on them. And so the IRS has indicated in some recent proposed regulations that they do not consider these arrangements to be an offer of coverage, and that they are probably also an impermissible interference with an employee's right to go to the exchange. So that they're kind of saying, we know people are planning on doing this, you better not do it or we're going to hit you with a hammer. At the same time, the IRS also released safe harbor plan designs. One of the requirements under the Act to be in sort of a penalty-proof environment is that you have a plan that provides minimum value. But the issue was, well, just what is minimum value? And so there's a variety of safe harbor plan designs that the IRS has just released that says if you design your plan within these parameters, we will consider that to be a minimum value plan. Now there are other ways to determine whether your plan meets minimum value, but these are some ways the IRS indicated that they agree with. I had mentioned the summary of benefits and coverage. That's an existing rule. That went into effect for most employers with their open enrollment last fall, thinking that most plans operate on a calendar year basis. And what that is a model form from the Department of Labor that describes the terms of the plan, the benefits, the cost of coverage. The Department of Labor, they just released an updated form for the next open enrollment periods, and some additional requirements. The updated template requires an employer to tell employees whether or not the plan that they offer provides minimum essential coverage and whether it meets the minimum value requirements. So the employee will know what they're buying versus what they could buy on the exchange. A lot of these disclosure requirements are to inform employees that they may have a better choice to go get exchange coverage versus coverage from their employer. And last on kind of the new info, this is just one part of the California marketplace cost of coverage, and it refers to a silver plan, which is a kind of a medium plan. A lot of plans employers sponsor might be something along the lines of a silver plan. And in this example, a 40-year-old, even if they don't qualify for subsidies, could buy a policy for $276 a month. So, these are the first ones that we know what they are. We anticipate that other exchanges might be higher. California was very aggressive in how they managed their exchange. They required employers or insurance companies to submit coverage requests, and they were not guaranteed that they would be accepted. They turned away more than half of the policies that were requested. So you've got 13 different insurance companies competing in California on their exchange, which is a lot higher than other states may have. Most states have 4 maybe 5 insurance companies that are going to be doing business. Some states like Vermont and New Hampshire may only have 1 or 2. So there will be no marketplace. It'll just be a way to buy the coverage because there's no competition. So that's kind of what's been happening. That was really the month of May, kind of the highlights. There was a lot more that was released in May because, like I said, typically every Friday, one of the agencies releases something, it's a conspiracy to ruin all benefit people's weekends. Because there's something that comes out and you have to decide, okay, am I going to read this over the weekend or not? So let's talk about what employers are subject to the penalty, the possible penalties. Those are large employers. A large employer is an employer that employs at least 50 full-time employees in the prior year. So these rules go into effect in 2014. So 2013 is what you would look at to decide whether or not an employer, at least an existing employer, is a large employer. A full-time employee is someone who is working 30 hours a week or more. Plus, you have this new concept of full-time equivalent employees, solely for the purpose of deciding whether or not you are a large employer. And what that is you aggregate all the part-time hours that are worked, you divide that by 120 for a month, and that would determine how many employees that are FTEs for the month over and above your full-time employees. So, for example, if you had 600 part-time hours worked in a month, you'd end up with 5 FTEs in addition to your real full-time employees. And then very importantly, this rule is determined on a controlled group or an affiliated service group basis. So if one person owns several companies, you're going to need to aggregate that and look at that on a controlled group basis to decide whether or not you're a large employer. Also unusual for employee benefit legislation, it includes everybody. Typically, the first part of any major employee benefit legislation says it doesn't apply to governmental entities, may not apply to churches, not-for-profits may have a delayed effective date. None of that happened with this legislation. It applies to everybody. As I mentioned, full-time employees are people who work 30 hours a week, or you can use 130 a month as an alternative definition. If you're right on the margin of being a 50-person company, one thing to remember is that partners, LLC members, 2% shareholders of a corporation, those are not employees for this purpose. It's only the common law employees. So, if you're really on the, right at that 50, you need to count carefully. There's also potential exclusions for seasonal employees, but if you talked about that, I'd need 5 more slides to go through that, so we're not going to talk about that today. And I've already covered here how you calculate an FTE, so we can move on. Normally, you'll look at this on a 12-month look-back basis, the prior year. For the first year, for 2013, an employer can look at 6 consecutive months. So you've got time to fire people and get yourself below 50 still. But the next speaker will tell you all the reasons why you don't want to fire people to get below 50, because it'd be a lot more expensive than what you might think. I put in here a little bit of information about control group. The point that I wanted to make was, for employee plan purposes, a brother-sister controlled group of entities is based on an 80% standard, not the 50% standard that applies to income tax. So I've already talked to some people who thought they had a control group for plan purposes that did not, because they were a control group for tax, but not for plan purposes based on the ownership of the different companies. So it's important to understand that. Another thing is to watch out for affiliated service group issues where you've got one company whose principal business is managing another. They can be aggregated even though there might not be any common ownership whatsoever. So there are potential other employers within a control group that you need to think about. There's also a new employer rule. So if you create a new entity after 1/1/14, the way you decide whether or not you're subject to the act is that because you have no prior year to look back to, you would have to make a determination on the first day of the company, do you reasonably expect to employ 50 people on average? And if you do employ those 50 people, you are a large employer from day one. And one of the things that you'll need to be looking at in creating that company is getting benefit plans in place in connection with the new entity. Employer penalties. To be penalty-free, a large employer must offer minimum essential coverage to substantially all of its full-time employees and their dependents, or pay a penalty tax. They also must offer affordable coverage that provides minimum value or pay a penalty tax. One of the odd things about this is that an employer does not have to provide coverage for a spouse, just the children. And there's also one of the rulings that came out from the IRS last year that has caused quite a bit of controversy is that the offer of coverage for dependents does not have to be affordable. It's only the employee's coverage that must be affordable. You can provide zero subsidy for the spouse and dependent coverage that you may offer. And so, what is an offer of coverage? You need to be given, employees need to have an opportunity to enroll. And it has to, and whether it's an effective offer of coverage or not depends on the facts and circumstances. So I would suggest that if you gave a new employee a form and said, you have to turn it in before you leave today, yes or no, are you in the plan? That might not be an adequate time to respond to that, and the IRS may not accept it as being an offer of coverage. Another rule is that you have to offer it to a full-time employee within 90 days of their date of hire. Not the next payroll period after 90 days, not the first day of the month after 90 days, after 90 days. So if you have a longer waiting period, you need to make sure that your waiting period and your enrollment practices will be consistent with the actually offering them within 90 days. That was a little surprising that the IRS did not, grant relief saying, first day of the month, like so many plans operate on. So, but for right now, it's 90 days. Another issue that you need to think about is a lot of people hire people through a temporary agency on a temp to hire basis. So what is that temp to hire person's date of employment? Is it the date they first performed an hour of service for you, which would possibly include their employment through the temporary agency? So you need to decide whether or not you need to offer them, enrollment immediately upon when you make them your employee as opposed to the employment agency's employment. Minimum essential coverage. The Act is well over 1,000 pages. But nowhere in the Act, in that 1,000 pages, do they find time to define what minimum essential coverage is. You know, it would have been nice if they would have went to 1,001 pages and put a definition in, but they did not. So basically, what you're really talking about is a group insurance policy. It has to have certain characteristics. There's new rules that come into effect in 2014 about annual limits, lifetime limits, full coverage of cost preventative services. But it isn't really a well-defined term, and that really is where the whole theory that I mentioned at the beginning of my remarks was, well, we can offer a really poor level of policy because it will meet minimum essential coverage and will make people enroll in that, and it will actually save us money. But that probably won't work. And then I can tell you what it's not. You know, it's not a standalone policy that offers, cancer insurance or just indemnity coverage, but I really can't tell you exactly what it is because it's not yet defined. We can talk about what an affordable coverage is. The statute says it's affordable if it's 9.5% of household income. Okay? Household income. Think about that from an employer perspective. That means I need to know my employee's husband or wife's income to know whether I meet this rule. IRS looked at this in drafting regulations and they thought, what a stupid idea that was. Because they recognize that employers don't want to know, probably can't ask the question. So that they've given some alternative safe harbors, and I've got them listed on the screen for you. 9.5% of Box 1 W-2 wages, 9.5% of the federal poverty line for the year, a rate of pay safe harbor. So they've given employers more workable solutions to decide whether or not what they charge for coverage is actually affordable than what the statute would have suggested. I also mentioned that to be avoiding penalties, you need a minimum value policy. So to be a minimum value policy, the plan must cover 60% of the total allowed costs in a variety of coverage areas. Physician charges, prescription drugs, hospital, emergency room, and the like. And I mentioned that the IRS just released a couple safe harbor plan designs. You can also go to the Health and Human Services website, and they have a calculator that you can download, and you can run the characteristics of your plan through their calculator, and it will tell you whether or not it meets the 60% minimum value standard. Or a lot of self-insured plans will probably have that certified by the actuary that they work with on the self-insurance aspect of it. So let's look at what the possible penalties are. The first possible penalty, and this is really the big one that you really want to manage and be sure that you are not subject to, that's the no offer penalty. If you fail to offer minimum essential coverage to at least 95%, and that 95%, that's IRS regulation. The statute just says at all. So, the IRS also thought, well, there's no room for error in the statute, but they gave some room for error in the regulations, which was, again, a very intelligent decision on their part to do so. So if you don't offer it to them, you can end up with a penalty. The penalty is On an annual basis, it's really a monthly penalty, but it's $2,000 on an annual basis. And so we'll talk, we'll use the annual number because I don't want to multiply $166.67 in my head in front of a room full of people. I could just ask Joe to do those for me, but we'll just use the 2,000. And so one of the things that you need to remember here, though, is that the penalty here is not on the control group basis. It's on the individual employer. So even though you had to decide whether or not you were a large employer on a control group basis, the penalty is assessed to each individual employer, and there's some planning that you can do around that. Then there's a second set of possible penalties. Really three different versions of it, and that is if you offer coverage to more than 95% of everyone, but you don't offer coverage to a few people, and one of those few people were to actually go to the exchange and get subsidized coverage, because that's the trigger for the penalty, you can get a penalty there of $3,000, but it's $3,000 only on that one person. So that's important to remember, that the second set is only on the people who actually get subsidized coverage. And I forgot to mention, but the penalty is also non-deductible, so it's really, for a for-profit business, a $2,000 penalty might really be more of a $3,400 penalty, and so on. The second, if you offer coverage to everybody, but you don't offer a minimum value policy, your policy doesn't meet that 60% standard. It has a very high deductible, very poor coverage, if people reject your coverage and they go to the exchange and they get tax subsidized coverage, they will get, that's again a potential penalty of $3,000, and it's again only on the one employee. The third version of that same $3,000 penalty is if your offer of coverage is unaffordable to part of your workforce. So you can say, we're going to charge $200 a month for health insurance, and we've got some full-time employees that's more than 9.5% of their pay. They can reject your coverage, go to this exchange, and buy it maybe on a tax subsidized, well, they would definitely be subsidized on the exchange, and that would subject you to the penalty on any employee that actually went and did that. And then there's a maximum penalty calculation. But let's talk about the strategies around that. We've got Mrs. Jones, and she owns Jones Incorporated, which has 270 full-time employees in its manufacturing division and 30 full-time employees in its distribution division. It does not offer coverage to the employees in the distribution division. So someone in the warehouse goes and gets tax subsidized coverage. What happens to Jones Incorporated? Here's how the penalty computation works. So we've got 300 full-time employees. There's a 30 employee free pass under the statute. So you would multiply 270 times 2,000, gives you a $540,000 non-deductible penalty. Okay, what can you do about that potential risk? You can offer coverage to the employees in the warehouse division, and that might be a sensible thing to do. Another approach is to transfer your employees from the warehouse division to a new company that will do the same job, wholly owned subsidiary. But now it's a separate entity. So here's what happens then. Same thing, one employee from the warehouse goes and gets tax subsidized coverage. The new computation is 30 full-time employees, because we're only talking about the employees that work for the actual employer in the warehouse division, less 3 employees, because you would prorate that 30 employee free pass, gives you 27 employees times 2,000 equals a $54,000 penalty. So by rearranging the entities, you drop the potential penalty from over $500,000 to $50,000. So that is a real case that I worked on, and I think their ultimate decision was that they're going to offer coverage to everybody. But you know, we did explore that, and you know, this was a potential, and that would have minimized their risk considerably. Here, you know, in this example, we've got 30 or 300 full-time employees. It's not affordable for everybody. 20 employees who are eligible for tax subsidies go get them on the exchange. The point here is that you only pay the tax on the 20 people who actually got the coverage. It's not on everybody. It's only those who went and got the coverage on the exchange, and that's, you know, much lower. Other penalty avoidance strategies. Reduce your full-time workforce. You know, if you don't offer coverage, but you don't have to make it affordable. You can say, my employees aren't going to go buy it. They don't make enough. That even with the tax subsidies, their income is so low. They've got rent, they've got car payments, they've got everything. They're not going to buy it. So I don't have much of a risk. You know, or you know, you can offer coverage that does not meet minimum value. Same kind of strategy. Okay, hours reduction. Our next speaker will talk about that, I believe, as to some of the risks there. But one of the risks is if you cut everyone back, they're going to look for a new job. And the other risk is that if you cut everyone back to less than 30 hours, well, if you still have the same number of units of work that must be done to operate your business, that only means you have to hire more part-time people, which then if you hire more part-time people, that's just more management, work that, you're imposing on people, just scheduling. You call someone in to cover for sick, and they go, well, I can't do that. I'm working on Thursdays. I work for Wendy's, because I need more money, than what you pay me. So there's a lot of problems surrounding that whole process. We've talked about, offering unaffordable coverage, assuming that, that most employees are not going to actually take your coverage or go to the exchange because they don't want it. And that's all very workforce dependent. A lot of employers I've talked to are convinced that no one's going to take coverage that doesn't take it already. If your strategy is that you're offering coverage that you don't think people will take, documenting that offer is very important. You want to have them sign something that says, no, I decline coverage. And you probably want to, scan that, save that to an off-site, backup file, and, so you can prove that you're not subject to the penalty. Offering less than minimum value coverage is, more or less the same approach of not providing a great plan with anticipation that people won't take it anyway. Again, documentation is critical, and you also have some potential issues in the non-discrimination rules. One of the things that a lot of employers have looked at in terms of ways to reduce their cost is when they've looked at this and they've kind of looked at what their current plan is, they realize that they are offering plans that are well above the 60% minimum value threshold. And a lot of them are taking the opportunity to offer employees a lower value plan that will cost the employer less money and the employee less money. So they're adding a second option, to meet that 60% standard. Often, a high deductible HSA type of approach, trying to drive their costs down and make it, and drive employee costs down as well. Because a lot of, several people I've talked to have at the end of the day been very surprised at how much better their plan was than what the statute called for. Because they didn't really realize what they were offering because they didn't understand the terms of their plan. A last point to make, and I probably won't really cover all these slides because I'm about to run out of time here, is that before the Affordable Care Act, plans that were insured through an insurance company, there were no non-discrimination rules that existed. There are existing rules for self-insured plans, and some variation of those rules are going to go into effect for insured plans, but the IRS hasn't released any proposed regs on those yet, and I don't even know what the timeline is for releasing those rules. But for a long time, there were no rules for insured plans, and they're coming now. So I think that really, to cover all this would really kind of take us past time. So I'll bring it to an end and let the next speaker come up.